What's up, family? This is your brother in the kingdom, Emmanuel Destiny. Welcome back to another valuable, knowledgeable video on the Forex Beginner series. As you guys know, that today is Monday, and I'm not sure what episode we're on number, but of course, we're talking about what is a Forex lot and how to calculate it and how to calculate your profits and loss, which ones to use, all within this video. So if you don't know that, kindly watch this video till the end. And of course, if you're a first-time viewer, kindly do subscribe, like, and switch on that notification bell to all videos so that immediately when I post a video, you are the first one to actually just see it. And of course, do comment down below on how this video has added much value. Some of you have skipped steps along your way of trading, and this information really rejuvenates you and lets you know where you actually missed it. Okay. What is a lot in Forex? So, of course, when we're talking about lots, it also gets to the word lot, and I'm gonna be explaining it right now. So, a lot is simply the unit of measure or measuring a transaction of amount. So let's say they're called lots because they're basically the number of currency units traded, or rather bought and sold. The last episode we talked about spreads and all of that, pips. So now we're getting in and we're building all the way from pips now to lots, understanding that. So basically it's the amount of pips or units that you're actually just buying within that whole transaction amount. For example, it's like an egg box, right? When you buy eggs, you usually buy in a carton or in a box. Okay, depending on what country you're on, you will understand. So one carton, or rather box, includes just 12, and then of course 24, and then that's how they actually measure it, by that in dozens. The very same thing that we have in trading, rather. Let me just make this image a bit bigger, guys, so you can see me nicely. So the very same concept that we have in trading, guys, is that we have a standard lot, which is 100 units, or stand for 100 units. So when that's the one where you have 1 and then .00. That's a standard lot. So it stands for 100 units. Then of course we have currency. Now we have mini, we have micro, and we have nano. These are types of lot sizes. Now I actually want to cover them here. Okay, so we have a standard lot where we have 100 units. Okay, then of course we have mini, which is 10,000 units. We have micro, which is 1,000 units. And then of course we have nano, which is 100 units. I hope you understand it. So basically, if I would explain it in this way, what you will actually see on your broker is something like this. I'm just gonna draw it for you. So one, that's a standard lot all the way to 200. Okay, and then of course you have your mini, which is basically now starts with a 0, and of course you can have all the way from 1 all the way to 0.90. And of course you have your micro, so which is now more or less this lot sizes right here. And of course micro and nano, they actually alternate. So from 100 to 1,000 you have all of these lot sizes there. I hope you understand it, guys. Now we want to move on to the next concept right here. Okay, so as you already know, the change in currency value is relative to another that is measured in what we call pips, hence we taught in the previous episode, which is a very small percentage of the unit of the currency's value. So to take advantage of this in this minute, a change in value, you need to trade large amounts of a particular currency in order to see any profit or loss. So now we're gonna get into some calculations just to let you understand this concept. For example, let's assume that we are using 100 units or standard lot size, and we'll recalculate some of the examples to see how it affects the pip value. For example, the first one here, we have USD JP1 and an exchange rate of 119.80. So let's say 1 pip So 0.1, you must have watched the previous episode, guys, to understand exactly what I'm talking about, because every episode is built on the other one, okay? So 0.1, which is 1 pip, stands for 1 pip. Of course, then we have divide by the exchange rate times the lot size. That will actually give you $8.34 per pip. So it shows you per pip, if you use one standard lot, that means it's gonna give you $8, approximately. Then of course you have USD chef. I'm just gonna do 2 examples there. USD chef at an exchange rate of 1.4555, and of course the calculation there is we take 1 pip divided by the exchange rate times by the standard lot size. That will be approximately $6.87 per pip. Why I say approximately? Because brokers differ in terms of lot size value or pip values. So you can actually go to a broker before you sign up and actually get to ask them, because it's going to be very much important as we get into this next subject, what is leverage, and where we get in we basically match the two. Okay, so we take leverage and we take lots in order to be able to calculate how much you will make in a profit or how much you'll actually lose when you're in a losing trade. Because it's very much important and paramount that we actually understand that, because you want to know what you're getting into yourself before you actually click on a trade. Okay, so what is leverage, guys? Very much important that you actually get to understand this. You're probably wondering, as you and I, we're small investors, we don't trade large amounts like 100 billion or 100 million. So we're probably wondering, how can we actually make a lot of money? And the image really explains this to say we're given leverage. Okay, so think as your broker, as your forex broker, as your bank, which basically lends you or borrows you 100,000 to buy currencies. Okay, all under what we call leverage. And of course, all the bank asks from you is that you give them $1,000 as a good faith deposit. So just a good example here, okay, is a good faith deposit, which it will hold but not keep or necessarily keep. Sounds good to be true? Well, that's what we call forex leverage. And how does it work? That 1,000 that you pay is actually what we call margin. Okay, margin. So once you've deposited your money, you'll be able to trade. The broker will obviously specify how much margin is required per position or per lot traded. For example, if you're allowed, or rather your leverage is 100:1, so 1% of your leverage is required. Okay, or of your percentage, or rather, okay, of your position, and you wanted to trade 100,000 worth, but you only have 5,000 in your account. So what does that mean now? What it does is your broker basically takes 1,000 on the side, okay, and puts it as leverage on your account. As you trade, you will see the leverage fluctuating, whether the price is going up or down, whether you're in profits or loss. So that's in essence, leverage is brought through margin. And of course, once you actually lose that kind of money, your broker either cuts you off, or most brokers can actually just cut you off. It's more like a safe deposit, but it's not. So they'll either just cut you off. Okay, so assuming that the US dollar trade, so for an example, let's say that you buy one standard lot, 100 units, of course, of the US dollar Japanese yen. And if your count is allowed 100:1, remember guys, the more leverage you have, the more advantage you can take with lesser margin. Okay, so the lesser the leverage, the more margin you need. So that's how we actually put 1,000 there. Okay, you will actually need just 1,000 as margin, and the 1,000 is not a fee; it's a deposit. You get it back when you close your trade eventually, right? And the reason the broker requires the deposit is that while the trade is open, there's a risk that you could lose on the money. So because they've borrowed you, technically they've borrowed you 100,000 to trade, but now that's that 1,000 acts as a margin, so the room for you to swing that trade. Assuming that the US dollar trade is only a position that you have opened in your account, you'll have to maintain your account's equity, absolute value of your trading account. So equity, for example, let's say you have 10,000 US dollars and your trade is on minus 1,000, so your equity will reflect as 9,000, and of course your equity will indirectly affect your margin. Okay, I hope you get it. Okay, so if the US dollar Japanese yen plunges and your trading causes losses on your equity to fall below 1,000, as I was just saying now, your brokers will automatically either cut you off. So most of the time, especially when now we're trading prop firms, we're actually learning a lot about this because they give us small leverage and then it actually just cuts us out. Apart from their risk parameters, that also the leverage limits us from either losing a lot or making a lot. Okay, so it's a safety mechanism to prevent your account balance from going all the way to losing your account. So that's why some brokers, they actually give you the highest leverage, so that it's basically a rope to hang yourself. You blow your whole money, you're gonna deposit again, you double your account, you're happy. What does it do? Happiness overclouds your mind. You do that again, it blows your whole account. So good brokers will know very well that as a trader, this is not gambling. You must actually have a limit to lose. Okay, moving on right now, we want to calculate, or we want to know, how do I calculate profit and a loss? So now let's know how to calculate pip value and leverage, then let's look how to calculate loss and profit. So let's buy the US dollar and sell the Swiss franc. As we understood in previous episodes, that when we buy a base currency, we are simultaneously selling the code currency. So that's why I put it like that, and I hope you actually remembered and paid attention to the previous lessons. So the rate that you're quoted for example, let's say it's 1.4525 or let's say 1.30. Okay, between that, because you're buying the US dollar, you'll be working on the ask, because it's a base currency we are buying. So you'll probably just take the ask, which will be the second one. Remember guys, the previous episode, the second one there, that will be your ask price. Okay, and the rate which the trader is prepared to sell. So now you will actually buy with one standard lot, for example, at 45.30. A few hours later, the price moves to 45.50. So basically, you will decide to close your profit. So what has actually happened there? The market actually went up all the way by about 20 pips. So using this formula now, again, there are other calculators that do this, but you can do it manually if you cannot find the right calculator. So you basically take 1 pip, times it by the exchange rate, times it by the lot size. You get exactly how much you make per interval, right? Per pip. Then you times it by the number of pips that you will eventually make. Let's say, assuming that you have not gone into the trade, you times it by the number of pips that you target, and it will give you exactly how much you will make or lose. But now this number may be affected, okay, due to different types of brokers and their conversion and pip counts. So it's very much important that you can actually get to ask, or in your broker's contract when you sign up and open an account, they'll usually send you that, but a lot of people don't actually open those documents up. So you must ask them. If they don't send that, some brokers they will list what are the pip values, so that you may know exactly how you're going to be affected when trading. Okay, thank you so much guys for tuning in. I think that's it for now. Again, we want to actually now you and I get to see each other on the next episode. And of course, this was a short video, but if you got so much value from it, please kindly subscribe, like, and switch on that notification button to get more episodes like this. As you know guys, I'm plugging you the best information, educational, so that if as a beginner you're watching this, we're starting with you from the very foundation all the way up until you eventually become rich, a billionaire, a millionaire, an entrepreneur. Of course, that's up to you. But thank you so much for giving me your time and for also, putting your time into this video. Thank you.